Is VVIX a market sentiment indicator? Have you ever wondered how traders gauge the mood of the market? One tool they use is the VVIX, or Volatility of VIX Index. This index measures the expected volatility of the VIX itself, which tracks the anticipated volatility of the Standard & Poor's 500 index over the next 30 days. Essentially, the VVIX reflects how much the market expects the VIX to fluctuate. So, how does this relate to market sentiment? The VVIX is not a direct indicator of market direction but rather a measure of the intensity of market sentiment. When the VVIX is high, it indicates that traders expect significant changes in volatility. This often corresponds to periods of uncertainty or nervousness in the market. For instance, during times of market stress or rapid price movements in the Standard & Poor's 500 index, the VVIX tends to rise. Conversely, a low VVIX suggests a calmer market environment. It indicates that traders expect stability and less fluctuation in volatility. However, it is important to note that the VVIX does not tell us whether the market will go up or down. It simply measures the strength of the current volatility trend. Typical values for the VVIX range from 75 to 100 in stable markets, with an average around 86. In more turbulent times, the VVIX can spike to 200 or more. For example, during the COVID-19 market crash, we saw significant spikes in the VVIX. Rapid price drops in the Standard & Poor's 500 index usually lead to these spikes, while slow declines have a lesser effect. For options traders, the VVIX is particularly useful. It helps them gauge the demand for options on the VIX itself. When market sentiment shifts quickly, traders often increase their hedging and speculative activities in VIX options. This drives up prices and, in turn, increases the VVIX. In this way, the VVIX serves as a practical tool for assessing volatility risk and finding potential opportunities in volatility trading strategies. So, is the VVIX a market sentiment indicator? Yes, it measures the intensity of market uncertainty and volatility expectations. While it does not predict market direction, it signals when volatility, and thus market nervousness, is likely to be high or low. This makes it a helpful resource for traders managing risk or looking to capitalize on changes in volatility.